This video is for educational and entertainment use only. The views in this video do not necessarily represent the views or life of Marlon.
Welcome back to Duffle LO, to Sit Down. And on this episode, we are now talking about how we have went from the moon to the sun to the Evergrande crisis to the bubble bursting to the ghost cities to the banks lending Evergrande the money. Like, we've been all over this, but it's all about China. Now let's start bringing China and the U.S. more closer aligned with each other, because this stuff is good. So let's get to it. I'm gonna be talking about China into the night, y'all. Trust me, I still got so many videos to go that it's a shame, but I ain't gonna stop. Y'all know I'm gonna keep on going. So bam, you see that? What that say? What do that say? Chinese stocks cut 600 billion from U.S. markets this year and are just getting started. This just came out 2 weeks ago, Friday, December 24th, 2021. Today, again, is January 12th, 2022. So let's get into it. Therese Paletti. Chinese stocks that trade in the U.S. have always been a double-edged sword for investors, but Americans now face a wicked blade as years of buildup leads to an inevitable end, because the stocks are trading on the U.S. stock market and the companies are being decreased in value. The stock market is losing all that money. After hundreds of sketchy offerings on the U.S. market for young China-based companies with huge potential for either growth or a complete collapse, the market and these stocks fell apart in 2021. Valuations have declined sharply. There have been no IPOs in the last few months, and there have been a number of going private transactions, said Jesse Fried, a professor at Harvard Law School. So you already know he in the game. Matthew Kennedy, a senior strategist with Renaissance Capital, an IPO research firm that also has two IPO-focused ETFs, said there were 30 China-based IPOs on U.S. exchange in the first half of 2021 and only 4 in the second half before the window shut. This year, he said 34 Chinese companies raised $12.6 billion by going public in the U.S., up from 30 deals in 2020 that raised $11.7 billion, excluding SPAC, Special Person Acquisition Corporation. SPACs, that's a lot of companies want to end up going public, but they can't go public, so they end up going public through a SPAC. But notice how the Chinese companies are going public in the U.S. to get capital. They companies not based in the U.S., they companies is based in China, but they allow people in the U.S. to invest in them, so China takes the money. And now, as you can see, because they've been doing all these companies every year, having people invest in all this and all that, 600 billion wiped. And look how much they made in 2020, 11.7 billion. And then 2021, 12.6 billion. That's only 24 billion together. But 600 billion got wiped. Look at this. Y'all gotta go back to 600 billion from U.S. markets this year. They cut it. But as you can see right here, that's 12.6, 11.7. So that means there's more companies, and China been doing this for a while. But the results for the U.S. investors who bought these stocks have not been as rosy. Even if the Chinese government and U.S. government gave these companies the green light, the average return for Chinese-based 2021 U.S. IPOs is negative 42%. Only 12% are trading positive, he pointed out. So that means over 1/3, and you want to say like what? Like I don't want to say 2/3, because it can't be 2/3. That's 66%. But we're going to say 42%. Let's leave it with 42%. 42%. So you got a 58% chance of your company doing good if you invest in a Chinese company. But like they said, majority of the IPOs that just came out, they are already down negative 42%. So your money already, is already, you might as well just throw it in the garbage and set it on fire. It isn't just the rookies who have suffered. In May, according to the U.S.-China Economic and Security Review Commission, there were 248 Chinese companies listed on the U.S. exchanges with a total market cap of $2.1 trillion. There were 248 Chinese companies, and they were at a market cap of 2.1 trillion. That value has fallen sharply to approximately 1.5 trillion, lopping off 600 billion. Wow. It's going down. The decline has left many American investors holding on to Chinese stocks with hopes that they will rebound. See, look, because if you understand anything about investment, you might as well hold on to it, because if you end up selling it, you're going to sell it as a loss, but it's a way that you should sell it as a loss, but that's neither here or there. That's deep into stuff. But the decline has left many American investors holding on to the Chinese stock with hopes that they will rebound or as potential losses to offset other taxable gains if they are sold in 2021. So that's what I was talking about right there. Y'all got to understand that line. But with a new U.S. law requiring more disclosures from the auditors of Chinese companies, combined with pressure from Chinese regulators on companies with a lot of data to list in China instead, it appears the market for Chinese stocks in the U.S. has blown up and more pain may be on the way. Okay, so now this is loaded. What this is loaded with and saying is the Chinese want their companies to go on a Chinese stock exchange so they can have that money in their country rather than putting it on a U.S. stock exchange. But if China got they got $1.5 trillion left, that's going to be $1.5 trillion that's taken out of the U.S. market, which is going to tank it. It's going to tank it. And then they put that in China market to up it. But as you seen in the other video, only 7% of Chinese population is into the stock exchange. So only 7% is into the stock exchange. But if they take the 1.5 trillion from the US and put it in China, that's 7%. They bread going up, up, up. Yeah, there's more pain on the way. China doesn't own these securities. U.S. investors do, said Brendan Ahern, Chief Investment Officer at the Crane Funds Advisors LLC, which has a suite of China-focused ETFs. That savings is at risk. So you see that? Now go to my Americans will be forced to deplete their savings in 2022 video. All this is connected. Didi delisting is an example of what is to come. When they delist the company, that means that company can, like, so you already got shares in the company, so that they're gonna keep your shares where you have your shares. You can sell them, but you can't buy no more. So once the company is delisted, nobody else can buy any more shares of that company, and then it's gonna go wherever it's gonna go. An example of what could be on the way for dozens of Chinese companies still listed on the U.S. market is Didi Global Incorporated. China's version of Uber was the largest initial public offering of the year in the U.S., but fell apart just days after listing, and is now delisted from the New York Stock Exchange and headed for Hong Kong. They came in, IPO'd in the U.S., everybody put their money in, and then the stock tanked, and the ones that was in the beginning, they left with more money, and those that came in the end, they got rug pulled. Oh, and now it's headed for Hong Kong. They came over here, took the U.S. money, and going back that way. Oh my God, y'all gotta understand. But watch how much more money they're gonna take. Didi was at odds with the Chinese government from the get-go when it went public in June. In July, the Wall Street Journal reported that the Chinese regulators had warned Didi not to go public in the U.S. because they believed the ride-sharing app company had too much data that made it a security risk. At its peak, after raising more than $4 billion from investors in its IPO, Didi had a market cap of about $80 billion. Its market cap is now $29 billion. So now this is the finesse. China tricked everybody and said, hey, no, we don't want y'all to IPO over there because y'all gonna have too much information on y'all app, because the data, the ride sharing is the people in China. They getting in them cars and going places. But because it's IPO'd in the US, the people the investors in the US will have access to that information. So China's like, no, don't go IPO over there, do it over here. But in reality, see, it was the Trojan horse. They put it over there, IPO'd over there, and then they knew it was gonna get ready to tank. So they all took their money, and now they headed to Hong Kong with the bag. What? Look, they in 2080. I'm steady telling y'all. The delisting of Didi in the US is an example of what could happen with many other China-based companies whose shares trade in the US as a new law. The Holden Foreign Companies Accountable Act, or HFCAA, is set to go into motion. Signed into law in December 2020, the HFCAA states that any foreign company that trades on U.S. exchanges must submit to inspections of their auditors' workbooks by the Public Company Accounting Oversight Board. If they don't, they will be delisted after 3 consecutive years of non-compliance, with this December marking the first year since the law passed. So now it just happened. So now they're going to give people 3 years in order to get in compliance. And if they're not in compliance, then they got to go. But in reality, think about this. China don't want they companies that's located in their country to be over there in the US, over here in the US, because if they audit y'all books, then that's information and data that they get on our country. Why would we allow them to see into our books and what's going on in our country? No. So they saying, okay, since they passed that law, we just gonna escape out the back door. They gonna leave out the back door, y'all. So when they leave out the back door, they taking their 1.5 trillion with them. They gonna be gone. Last month, the Securities and Exchange Commission finalized the rules that will require foreign companies give a PCAOB the documents or so-called workbooks used in overseas financial audits. In addition, companies must provide proof that they are not controlled by their governments. Oh my God. Uh-oh. See, look, that's why the Chinese government trying to tell them, no, get y'all ass from over there and bring y'all ass back home. This is why they're saying that, because if the U.S. passed a law saying that the companies got to provide proof that they're not controlled by their governments. Hold on. China controls everything over there. This is communist. So wait, what? So that means a lot of them companies automatically finna get ready and get out of here. You see the Evergrande crisis. You see they got all them cities over there that's empty. All this is connected. So the U.S. is basically them to forcing them that they gotta go. And China, oh, okay, cool, we're gonna go, we're gonna dip over here with our bread. When we go, we're gonna dip with our bread too. So that's gonna tank the U.S. economy. Wait till these videos, just wait till these, boy, check them videos out up there. Look at them, because they come. Look, because they come. But let me keep going. Many Chinese companies have board members with ties to the Chinese Communist Party or the Chinese military. So you already know they kind of controlled by the government. So now they got to get out the U.S. Everyone knew this was coming, so it wasn't a surprise, says Joshua Dawes, counsel with the King and Spalding in Washington, chief negotiator for the PCAOB with Chinese regulators from 2011 to 2015. The SEC finalized the rules implementing the HFCAA, and the PCOAB has determined already that China and Hong Kong are non-cooperative jurisdictions. So it looks like this is going forward. Bro, the U.S., this is why they saying the Great Reset, and this is why they saying that the stock market is going to crash 90%. The reason why they're saying that is because once all these Chinese companies start withdrawing their money out the stock exchange because they got to go somewhere else, a lot of the stocks going to start going down. So a lot of the hedge funds, they going to start dropping the stocks. So when they start dropping the stocks going to really go down. So it's the retail investors is going to end up thinking that, oh, it's going back up if they don't understand this information and what it's saying. So they not going to jump ship too fast. They going to think they going to hold on. No, the ship is going down. It's about to get ready and go down, all the way. In mid-December, the China Securities Regulation Commission, CSRC, said it was in talks with the U.S. regulators regarding cooperation over the audit of U.S.-listed Chinese firms, and that it was making progress. So they're saying, we're gonna work with y'all. The CSRC, China's version of SEC, put out some interesting comments. Said a herd of crane funds. My read is they would like to solve this issue. They continue to engage the SEC and the PCAOB. There might be some more dialogue or communications between the two sides. It's going to go down. It's like a tug of war between U.S. regulators and the Chinese, said Paul Zerwin, a professor of accounting at New York University Stern School of Business. The CCP and Chinese President Xi Jinping are trying to get more control over everything. China wants total control over their population. And when they get control over everything, with their sun, with their moon, with all this, what they coming with, oh, when I say it spells world power. Like that, you can see the writing on the wall. Because if you can't see the writing on the wall, I'm giving you the writing on the wall. That's why it's gonna turn nighttime by the time I'm done with all these videos. Man, I'm telling you, just watch the clock. Y'all can look up that right there. You see that Wednesday, 4:23. You're gonna see. I don't know what time I'm finish all these videos, but let's go. Harvard's Fried said that despite the recent comments, he remains skeptical that leaders will allow China-based auditors to be inspected by the PCAOB, citing what happened with Didi as an example. So they might allow the Chinese to come over there and then they kind of oversee like what's going on. But you never know. If they are this paranoid about sensitive info falling into the hands of Americans because the companies are listed in the U.S., it seems unlikely China will let the PCAOB into the country to inspect audits, Fry said. And that means the end game under the HFCAA will be forced the listing of these companies, even if China does not force them to come home. So even if they don't even come home to China, they still got to get off the U.S. stock exchange. And when they get off the U.S. stock exchange, guess what? They take their money and they go into Hong Kong with it. Moving to Hong Kong is the best possible outcome. They spelling it out for you. You have to understand the writing on the wall. You have to understand how to put all this together. If you don't understand how to map this out and put all this together, you're going to be right there. This is what you're going to be. This is exactly what you're going to be. Stuck. That's what words you're going to be. You're going to be stuck. That leaves American investors stuck, waiting to see what will happen, especially with the popular stocks such as Alibaba Group Holden. And you know, everybody's shopping on Alibaba. If they stop sending stuff from over here, oh my God. Oh my God. Everybody is making money on Amazon Prime. They're making money on Shopify. All the stuff coming from Alibaba. And if they say, you know, Alibaba got to lead the U.S. stock exchange, they take all their money to China. What if China say, you know what? Now we don't want to send none of our items over there to the U.S. Uh-oh. At this point, we're in a wait and see mode to see how it works out, said Dan Morgan, the senior portfolio manager at Synovus Trust Company, which owned about 30,000 shares of Alibaba as of early November. As they wait, their investments have already been tremendously devalued by a market expecting ongoing turmoil and potential delistings. Alibaba has lost roughly half its valuation in 2021, while the Investco Golden Dragon ETF is down about 47% year to date, and the Crane Share SCI China Internet ETF is down around 51% year to date, with most of those declines coming after this column warned against holding China-based stocks last summer. So basically, these people already said, basically, they end up warning about holding them stocks because of what was getting ready to come. Everybody held on to them. But guess what? The people that was in initial, they already went out the window. It's crazy. But Alibaba has already seemingly prepared for possible listing for the U.S. markets. In November 2019, Alibaba shares began trading on the Hong Kong Stock Exchange, so they already ready to transition as a secondary listing, where it raised an additional $11 billion in capital. That was 5 years after its initial IPO in the U.S. Now, man, I told y'all earlier, only 7%, and look at the other deal, only 7% of the population in China actually works or actually invests in the stock market. They all invest in real estate. For investors holding the big cap Chinese stocks, a move to the Hong Kong Stock Exchange is the most straightforward and the best possible outcome. That will include some of the biggest U.S. IPOs of the last 2 years, like e-commerce company Pinduoduo Inc., which has U.S. market cap of $68.6 billion, and election car maker Neo Inc. with $46.1 billion U.S. market cap. These is listen. I'm showing y'all step by step. They got them cities over there empty because when they change and they become the world power, people from London, y'all come right over here, bring London over here because we always got something look like London. People from Paris, y'all go ahead, come over here because we got something like Americans, y'all come over here, y'all like apartments, we got all them over there right here. Y'all want to make money over here? Come to the Hong Kong Stock Exchange. Come to the Hong Kong Stock Exchange. Not only y'all to come to the Hong Kong Stock Exchange, we're gonna get to the yuan. We're gonna get to the yuan. Just watch this, y'all. A large share of U.S. companies subject to delisting already have secondary listing in the Chinese market, said Andy Rothman, an investment strategist at Matthews Asia, the largest dedicated Asia investment specialist in the U.S. But he added that the looming situation is an example of why investors who want to get in on China's growth should work with professionals, because institutional investors have an easier conversion of American depository receipts, ADRs, to other exchanges. Now you're going to have to go to the Vanguards, the BlackRocks, all that type of stuff. You don't have to go to them because they already know how to take their money over there to China. They already know this. They already know how. So the institutional investors, everybody going to have to go to them because the retail investors, they don't understand. They stuck on these apps. They stuck on E-Trade, Robinhood, all that type of stuff. Y'all stuck on stuff like that. The real people that's really the institutional people, Vanguard, BlackRock, Berkshire Hathaway, State Street, them names, if you don't understand them names, you better Google them, slow this video down, reverse it 10 seconds, go back, Google them names, slowly but surely, and understand finances. I'm trying to show y'all how this stuff is connected. Y'all have to understand this. This is real. They don't got them empty cities over there for nothing. Boy, they know people, they finna make you come over there. They finna make you come over there. You wanna make money? Put your ass over there. If an institutional investor owns ADRs in the US, say use Alibaba as an example. It is only an administrative paperwork process to convert those shares. It's not a taxable transaction. You don't have to make it a market in it. You don't have to make a market in it, Rothman said. So it ain't even taxable. Oh my God. And then think about this. You finna take your US money and you finna take it to a whole nother country and it ain't gonna be taxable. But guess what you finna do? You gotta convert it to their money. You gotta convert it to their money. They've been planning this. Oh my God. Oh my God. They got this shit. Oh my God, excuse my French, but they got this state. Oh my God. They got this seriously set up. And I'm not even nowhere near done with my videos. Bro, it's about to do this right here. It's about to crack. It's gonna crack. Robin said China is an enormous market that is impossible to ignore, but that it is a complicated and difficult market to understand because it's government ran. It's government ran, and they don't really understand the stock market because most of their population don't participate in it. So they ain't got no New York Stock Exchange over there in China or in Hong Kong, but they got something similar to it. But when they bring people from the Bank of London, they bring the New York Stock Exchange over there, those people that come from those places over there to China, they're gonna build it. Oh my God, they're gonna build it up and they're gonna get paid. What? World for the change. I told people 2024 is gonna be a whole new world. But this is why Matthew was set up about 3 decades ago. It requires a lot of stock picking and due diligence because it's a hard market to crack. There have been a couple of fraud cases, but it would be a mistake for investors to turn their back on the market simply because of that. World pools. Adding that he was selling his own book, Rodman noted that the fund managers and Matthews don't take face value any of the numbers that come out of China. We want to do our own due diligence to make sure we are comfortable with the numbers and the management because China, the Chinese government run everything, so they don't have to let you know what's really going on over there. In order for you to know what's going on over there, you got to go over there, but they still ain't got to let you know what's going on over there because they're a communist country. Individual investors may be left out. That's all these retail investors. The listing process, as this column has said before, will hurt the retail and individual investors the most. If they are not prepared, companies that haven't established a dual listing and don't meet the requirements to move their shares to Hong Kong Stock Exchange will be the most dangerous to own going forward. So if you got your stocks on any exchange that have not established a dual listing, right here, you see that? It have not established a dual listing and don't meet the requirements to move their shares to Hong Kong, you gonna be, let me highlight this so y'all can see what they say. I just want this a little bit. No. Just this. That's all. That's it. If you got your shares on a company that have not established a dual listing and don't meet the requirements to move the shares to the Hong Kong Stock Exchange, that's going to be the most dangerous place to hold your shares going forward. Why? Because now your shares going to just them to be zero. Because they won't exchange. They don't have the dual listing. So you gotta I'm telling you, hopefully, if you guys don't understand anything about long-term capital gains, that's why I say y'all gotta talk to me about that off this. Hopefully you held your shares for over a year and then you sell them before all this happened. Hopefully. The Hong Kong Exchange has a complex set of requirements for companies to list. According to a recent Morgan Stanley report on the HCFAA and its implications, a company is required to, among other things, have a market cap of at least $2 billion at the time of listing and latest annual revenue of at least 500 million. You got to at least have a market cap of 2 billion, and your revenue your latest annual revenue got to be 500 million. Ooh, what if you only made 495 million? Oh, no, can't get on there. What if you only had 1.9 billion? Oh, no, can't get on there. What? They want that bag over there. In addition, they're required to have a positive 3-year aggregate operating cash flow, oh my God, of 100 million or more. So you're a brand new company and you hopping on the exchange. No, you got to be a well-established company that's been around for a while. That's why, oh my God. They know what they're doing, bro. Y'all better know what's going on. Rotman pointed out, however, that he believes that Hong Kong Stock Exchange will probably make some changes to its listing requirements because they're going to want more companies to come over there. I suspect there will be changes to the Hong Kong market to accommodate the better quality of companies that have to leave here, Rotman added. I also expect Beijing and Hong Kong would change the rules to allow mainland investors to invest in companies like internet companies. So, if they bringing 8 companies back, they're going, all right, we're going to kind of wiggle y'all in here. There will be some companies, though, that don't qualify. Companies that don't meet those requirements will likely look for buyers in private equity deals after their stocks have been battered either by news or by rumors leading up to the listing. How much more? Oh, I'm almost all right. It will be very bad outcome for American investors if they are cashed out. Oh my God. Rather than getting new shares tradable on the Hong Kong Stock Exchange, because they're gonna just cash you out. What they're saying is they just gonna if you got $10,000 worth of their stock, they're just gonna cash you out 10,000 and now all your stocks are gone. Even if it's a positive or a negative. Investors should understand what is going to happen to these firms. They are relatively safe in the bigger companies, but they are more vulnerable with the smaller companies. An example of the smaller companies that went public in the last 2 years with huge hype that could potentially pitfall includes Kototo Inc., a mobile content company which went public in September 2018, which has tumbled 98% on an all-time basis. Ooh, that's like you put in $1, you only got 2 cents now. It currently has a market cap of around 81.6 million. Another controversial company is iQIYI Inc., a video streaming company trading down 79% on an all-time basis. The so-called Netflix of China went public in March 2018, but was the target of a scathing report by short seller Wolfpack Research and most recently regulatory uncertainty. iQIYI has a U.S. market cap of 3.57 billion. Y'all better look at the numbers and know what the numbers mean, boy. For investors holding some of the smaller companies, it's worth considering taking some losses now before they completely disappear from U.S. exchanges. And for those U.S. retail investors who want to be part of the huge growth of China, it makes sense to work with professionals who won't have any issues holding foreign shares. Oh my God. And that's the end of it. That's the end of it. Y'all got, let me tell you what they're telling y'all. Let me put this in low terms, because that's what this is. This is low terms. What they saying is, Vanguard, BlackRock, State Street, Berkshire Hathaway, Morgan Stanley, JP Morgan Chase, they already got the most shares of a lot of these companies already. Do your due diligence and do your research. They already got that. So if you think that these type of investment hedge funds ain't gonna already know to shift their money over there, they gonna already know to shift their money over there. I'm gonna show you how I already know that they gonna shift their money over there, because I already got an article I'm gonna get ready to talk to y'all about in two more pages. In 2 more articles, I'm going to show y'all. Because guess who get ready to shift their money over there? He didn't get ready to. He already did. Charlie Munger. Who's Charlie Munger? That is Berkshire Hathaway. Y'all got to understand these names. What? Bro. It's going to get ready to go down. So hopefully you guys learned something in this video. Like, share, subscribe, leave a comment below. This is getting crazy and crazy. I told y'all we're going up and up and up. Wait till it's all said and done. Y'all gotta watch this from the beginning. Start with the moon, and then every day after that, lead up to this. So if you started right here, you need to go back. Start the moon and then watch it, and then you'll understand the whole play, because the play is crazy. So, like I said, man, please prosper through adversity. Don't underestimate family, friends, lovers, enemies. Always look objectively. No matter what city, state, or country is in, every hood is the same. And if nobody told you they love you today, I'm gonna tell you I love you right now, because guess what? I love you. That's why I'm bringing you guys this information for you guys to understand, overstand, and understand what's going on in the world. And I'm putting it to you in a way that you can totally understand it, even if you've never been introduced to it. So make sure you like, make sure you share, make sure you subscribe, make sure you hit the bell when you subscribe. Get some of the books down. Get some of the books. Buy some of the books. All it's getting crazy. I gotta put this on charge because it's getting ready to die. So I gotta take at least a 10-15 minute break to come back and then do the rest of the video. It's going up. I told you, China. Y'all better get ready. That's all I gotta say for this video.
This video is for educational and entertainment use only. The views in this video do not necessarily represent the views or life of Marlon Dixon.